Right now, your family cannot touch a single dollar in your bank account if you died tonight. Not tomorrow, not next week. A will would not help them. A notary would not help them. An attorney-drafted estate plan would not help them. There is one free form, one that bypasses all of it. And the reason most people have never been told it exists is simple. Nobody whose job depends on the current system has any incentive to tell you. My name is Robert James. I represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS and from bank compliance officers on behalf of real people. Before we continue, if you enjoy videos that help you better understand retirement finances, banking, Social Security updates, tax topics, and practical ways to protect your hard-earned money, take a moment to like this video and subscribe to the channel. We publish new videos regularly to help you stay informed so you can make more confident financial decisions. Now, let's begin with the biggest misunderstanding almost everyone has. Many people believe that once they have a will, everything connected to their finances is automatically taken care of. It's an understandable assumption, but when it comes to bank accounts, there's an important distinction that surprises countless families every year. And until you understand that difference, you may not realize why this topic deserves far more attention than most people give it. Most people believe that once they create a will, their family can simply walk into the bank and access the money. But that's where a major misunderstanding begins. A will is an estate document. A bank account is also governed by the contract you signed with the bank. And in many cases, the bank looks at its own records first, not the paperwork stored in a safe deposit box or filing cabinet. That means if the account is only in one person's name and no beneficiary is listed, the bank may require additional legal steps before releasing the funds. For some families, that process is straightforward. For others, it can mean weeks or months of delays while documents are reviewed, estates are opened, and legal requirements are completed. What makes this especially important for seniors? Because many retirees have a large portion of their savings sitting in checking, savings, money market, or certificate of deposit accounts. Those funds are often intended to pay funeral costs, medical bills, mortgage payments, and other immediate expenses. Yet many account holders never realize that the way the account is titled can matter just as much as the amount of money inside it. And here's the question almost nobody asks. If a simple beneficiary form is available at most banks for free, why do so many people still leave their accounts without one? The answer may surprise you in the next section. Imagine this for a moment. A husband or wife passes away unexpectedly, and within days, the surviving family needs money for funeral arrangements, household bills, insurance payments, or medical expenses. They arrive at the bank, believing everything is in order, only to learn that the bank cannot simply hand over the funds because it must first follow legal procedures and the account agreement on file. For families who have never experienced this before, that conversation can come as a complete shock. This is why so many financial professionals encourage people to review their account ownership and beneficiary designations long before they're ever needed. The good news is that at many banks, adding or updating a payable-on-death POD beneficiary for eligible accounts is a straightforward process and typically doesn't cost anything. That designation tells the bank who should receive the funds after your death, helping eligible accounts pass directly to the named beneficiary instead of becoming part of a longer estate process. But don't assume you're fully protected just because you filled out paperwork years ago. There's another mistake that's just as common as having no beneficiary at all, and in some cases, it can create even bigger problems than you might expect. One of the biggest reasons this issue catches families off guard is that beneficiary forms are often treated as a set-it-and-forget-it document. Someone opens a bank account 20 or 30 years ago, names a beneficiary, and never thinks about it again. But life changes. People get married, divorced, remarry, lose loved ones, or simply want their savings to go to someone different. If those changes aren't reflected on the bank's records, the outdated designation can create confusion at exactly the wrong time. That's why financial experts recommend reviewing your beneficiary information after every major life event and revisiting it every few years, even if nothing has changed. It only takes a few minutes, but it can prevent unnecessary complications later. And here's something many people don't realize. Having a beneficiary isn't the only part of your banking setup that deserves attention. The way an account is titled, whether it's individually owned or jointly owned, can also affect what happens after the account holder dies. Many people assume adding a family member to an account is the safest solution, but that decision can come with consequences they never expected while they're still alive. That's where our next point becomes especially important. Many seniors choose to add an adult child or another trusted relative as a joint owner on a bank account because they believe it will make life easier if something happens to them. While that approach can work in some situations, it isn't always the best solution, and it's important to understand the trade-offs before making that decision. Depending on state law and the type of account, adding someone as a joint owner may give them immediate ownership rights while you're still alive, not just after you're gone. That means the account could potentially become entangled in certain legal or financial issues involving the joint owner, such as creditor claims, lawsuits, or divorce proceedings, depending on the circumstances and applicable laws. This is one reason many financial and estate planning professionals suggest discussing the best ownership structure with your bank or an estate planning attorney instead of assuming joint ownership is the safest option. So, if simply adding another person's name isn't always the answer, what's the better alternative? And how does the free beneficiary form mentioned in the title help you avoid many of these complications without giving up control of your money while you're still living? That's exactly what we'll break down next, because this is where many people finally understand why that one form receives so much attention. So, what is this free form that so many people overlook? In many banks, it's called a payable on death (POD) beneficiary designation. For eligible deposit accounts, this form allows you to name the person who should receive the funds after your passing. As long as you're alive, nothing changes. You remain the sole owner of the account. You control every dollar in it, and the beneficiary has no right to withdraw money or make decisions about the account simply because their name is listed. The real purpose of a POD designation is to give the bank clear instructions for what should happen after your death. Instead of leaving the bank to determine whether additional estate procedures are required for that account, the designation provides a direct path for transferring eligible funds to the named beneficiary once the required documentation, such as a certified death certificate and identity verification, is provided. Processing times vary by institution, but in many cases, it's significantly faster than waiting for an estate to move through probate. But before you head to your bank and ask for this form, there's something many people misunderstand. A POD designation isn't a one-size-fits-all solution, and it doesn't automatically cover every financial account you own. Knowing which accounts it applies to and which require different paperwork can prevent another costly mistake. One of the biggest misconceptions is that a single beneficiary form automatically covers every dollar you own. It doesn't. That's why reviewing your financial accounts one by one is so important. Your checking account may allow a POD designation, while your brokerage account may use a different type of beneficiary form. Retirement accounts, such as IRAs and employer-sponsored plans, already have their own beneficiary designations, and those should be reviewed regularly as well. Assuming one document covers everything can leave unexpected gaps that your family won't discover until they need access the most. There's another mistake that financial professionals see far too often. People complete the paperwork once and never look at it again. Years pass, families grow, relationships change, beneficiaries move, names change after marriage, or someone listed on the account passes away first. If your records no longer reflect your current wishes, your family could face unnecessary complications or delays. That's why many experts recommend reviewing all beneficiary designations after major life events and making it part of your regular financial checkup every few years. Now, here's the question that really matters. If you wanted to make sure your family isn't left guessing, what practical steps should you take this week? In the next section, we'll walk through a simple checklist that can help you review your accounts with confidence, without making assumptions that could cost your loved ones time, money, or unnecessary stress. If you're wondering where to begin, the good news is that you don't need to overhaul your entire financial plan overnight. Start with a simple review. Make a list of every bank account you own, including checking, savings, money market accounts, and certificates of deposit. Then contact each financial institution or log into your online banking portal to see whether a beneficiary has been designated for each eligible account. Don't assume that because one account has a beneficiary, they all do. Many people are surprised to discover that each account may require its own review. Next, confirm that the information on file is still accurate. Are the names spelled correctly? Is the beneficiary someone you still want to inherit those funds? Do you have a backup beneficiary in case your primary beneficiary passes away before you? These are simple questions, but they can make a meaningful difference when the time comes. Finally, keep a record of any updates you make and let your trusted family member or executor know where your important financial documents are stored. You don't need to share account numbers or balances, just enough information so they know which institutions to contact when necessary. But before we wrap up, there's one final misconception that causes many people to believe they've done everything correctly, when in reality, they may still be leaving their loved ones with avoidable complications. That final point may be the most important one of all. Yes, I think this can be significantly stronger. Right now, it reads more like an article than the ending of a high-retention YouTube video. The final module should make viewers feel they learned something important, reinforce the promise made by the title, and end with a memorable takeaway. Here's a stronger version. As we bring everything together, remember this: the biggest mistake isn't failing to save money. It's assuming your savings will automatically reach the people you love the way you intend. Many people spend a lifetime building financial security, but never realize that their bank account paperwork may deserve just as much attention as their will or estate plan. That's why today's topic matters. It's not about creating fear. It's about avoiding preventable problems before they ever have the chance to affect your family. If you haven't reviewed your bank accounts in years, make this the week you do it. Contact your bank and ask whether each eligible account has a current payable on death beneficiary designation. Verify that the information on file still reflects your wishes. Review any retirement or investment account beneficiaries separately, and don't hesitate to ask questions if anything is unclear. A simple conversation today could spare your loved ones unnecessary delays, confusion, and added stress during one of the most difficult times of their lives. The title of this video wasn't meant to alarm you. It was meant to remind you that small financial details can have lasting consequences. The good news is that this is one of those issues you can often address before it ever becomes a problem. And when you take a few minutes to review your accounts now, you're not just organizing paperwork. You're giving your family greater peace of mind when they'll need it most. If you found today's video helpful, please give it a thumbs up, subscribe to the channel, and let us know in the comments. Have you ever reviewed the beneficiary designations on your bank accounts? Or is this something you'll be checking after watching today's video? Your experience could help someone else avoid a costly mistake. Thanks for watching, and we'll see you in the next video. Before you go, remember that the purpose of today's video wasn't to make you worry. It was to help you stay one step ahead. Financial security isn't just about how much money you've saved over the years. It's also about making sure your wishes are clearly documented, so the people you care about aren't left facing unnecessary delays, confusion, or avoidable legal hurdles. Sometimes the smallest pieces of paperwork can have the biggest impact when your family needs them most. If you found this information valuable, please take a moment to like this video and subscribe to the channel. Every week, we break down important topics about banking, retirement, Social Security, taxes, and personal finance in simple, easy-to-understand language, so you can stay informed and make confident financial decisions. And we'd love to hear from you. Have you ever reviewed the beneficiary information on your bank accounts? Or is this something you'll be checking after today's video? Let us know in the comments below, because your experience could help someone else avoid a costly mistake. Thank you so much for watching. Take care of yourself and your loved ones, and we'll see you in the next video.